Alright guys, welcome back to MMGinvest and WolfPack Cryptos. Today was a big day. It was a very big day for the markets, for the central bank, and for gold. Gold broke out in a very big positive way. Now, I am going to talk about the implications of this FOMC meeting, and I am actually going to do some commentary on it. So I sliced and diced up. I recorded the FOMC meeting, sliced it up so it's not long, so there's only about 15 minutes, and then I'm going to lay on top of it my commentary and my thoughts. So, the markets broke out, they went higher because of this Federal Reserve meeting. Gold also broke out. Now, why did that happen? It's because the Fed capitulated. Now, a lot of you probably do not know exactly what I am talking about. And if you're new, I'm going to recap on the entire situation. And I'm going to try to do it in 3 minutes. Okay? So, one second. So, what happened is, in 2008, we had the financial crisis, right? We had the financial crisis in 2008, and it happened because Alan Greenspan blew a giant bubble by money printing and artificially low interest rates. Interest rates that the Fed tampers with. That is the interest rate on all loans and debt. All the loans that banks give out for your mortgage, your cars, for businesses, for corporations, for everything. And this has become an international problem because whatever the Fed does, all the other central banks do around the world. So in 2008, when the housing bubble popped in the U.S., it also took down most of the rest of the world, except for Australia, for some reason. Now, the Fed has had artificially low interest rates around 0% since 2009. And then they slowly started raising them the beginning of 2016. And they have been raising them ever since. But very small raises, a quarter basis point. Right now, the Fed rate is at 2.25 basis points. The interest rate is supposed to be normalized now because the economy is so strong, the stock market's so great, it's in the longest bull market ever, and the United States economy is supposed to be the strongest that it's ever been, which isn't true if you live in Main Street, right? Now, a normalized interest rate is like around 8%. The Federal Reserve cannot raise interest rates to a normal level because if they do, all the debt that's out there that has accumulated, the interest rate on that is going to go higher and it's going to pop the debt bubble. And the debt bubble has become everything because of a malinvestment, because of artificially low interest rates. This is not a free market. This is a centrally planned market. That's the problem. Now, the Fed right now, Jerome Powell, the new Fed chairman, he pretty much just capitulated, meaning he stopped raising interest rates. And today was the first. They didn't lower interest rates; they just didn't raise them. And people are like, "Well, if the economy's so strong and everything's so great, why did you stop raising interest rates?" And obviously, the answer is the stock market fell 20% in the past 2 months. And, once it falls past 20%, we're in a bear market. That means we're going into a recession. And that is exactly why they right now did not raise interest rates. Now, the market has had a huge bounce, and it's been recovering for a couple weeks now. And that's because of what Jerome Powell has said a few weeks ago. You see how that works? Because the stock market's addicted to cheap and free money. Now, the Fed, yes, they stopped quantitative easing, which is directly just printing money. But having artificially low interest rates means that the banks, like JP Morgan, Citigroup, all of them, Bank of America, they can print money. And the way they do it is is through fractional reserve lending. So if the bank has $10, that means they can lend out $100, and then poof, they just made money out of thin air. And then having artificially low interest rates gives the banks the power to lend out money they don't have. And then who's got to pay that back? You, me, your poor average citizen who has no idea what economics is, no idea what central banks are, and because they don't teach us in school. All right, or properly at least, not even in college. So the Fed is stuck in a corner. It's caught itself in a box. They can't raise interest rates, and they're supposed to be raising interest rates in a strong economy. And what that signals to the market is that the economy really isn't all that strong. But the stock market keeps going higher because right now the Fed has stopped raising interest rates, because raising interest rates pops the stock market bubble and the loan bubble and the everything bubble. So the dynamics are complex, but they're really not. So the Fed has to, in a way, pretend that the economy's strong, but they're not going to raise interest rates because of other factors, and at the same time, they have to pretend like they're going to in the near future because the economy's strong. So it's a con game. It's a confidence game. And that's how all Ponzi schemes work, right? So let's get into it. The chart's on the right over here. If you look on the screen, let me take away the camera views for a second. All right, so the chart's on the right. On the top is the spider ETF of the S&P 500, so you can see the movements quicker and easier. And gold on the bottom here, the gold futures chart. So gold, right before the rate decision, was at $13.08, so $1,308. And here was the S&P ETF at 265. So let's get into it, guys.
That today? It's important because it's tightening liquidity all over the world, and you really first felt it in emerging markets and overseas. And so I think the market is concerned about both the pace and the level at which the Fed is going to wind up on the balance sheet. And if it wants to see or hear a signal that the Fed is opening to going slower, I don't think they're going to hear it today.
Is there still a disconnect between where the markets are and where the Fed stands, David, in your view, in that the Fed is probably not going to want to signal an end to tightening, an end to rate hikes, an end to balance sheet runoff, but the markets want to hear that, and they sort of expect to hear that at this point.
I think the market's going to get a good deal of what it wants today.
All right, so you have to understand, the stock market, the Fed can't spook the stock market that the economy is weakening. So they have to keep hiking rates. But at the same time, the Fed needs to stop hiking rates, because if they keep hiking rates, the stock market's going to keep crashing. And then that's going to take down the economy as a whole anyways. And that's what they were just talking about. But the Fed is not supposed to be controlled by the stock market. It has to be independent from that. They only are supposed to look at economic data. And by the way, economic data did come out today. Some of the numbers were better for unemployment or wage growth. But these numbers are, I can't trust them. If you go to shadowstats.com, the way they used to do the economic data 30 years ago or 20 years ago, they've changed it so they could sort of, make the numbers look better than they always do. And not just that, they always revise them a month or 2 months later when on the economic data that they release, which affects the markets as well.
Yeah, I think, first of all, the statement itself, they're going to have to tone down their language, because they were talking about further rate increases. Right. And we think the Fed maybe only does one more, probably won't want to do March. So I think they're going to tone that down. And then on the balance sheet, the real trick is, can they say that they're easing off the monetary tightening? But they're doing it, they're applying the brakes, but not because they see a crash out in front of them on the highway. It's because they're reaching their destination. The truth is,
that's a tightrope, Alicia.
It is really a balancing act today. So on the one hand, the Fed needs to signal that the economy is good enough, but not too strong. And the other hand, that the economy is not going into recession, because it doesn't want the market to take the signal that it's on autopilot. It's a tightrope here, and I expect Jay Powell to do a pretty good job with it.
But they want to basically say we're not doing anything further because we don't need to, not because oh my gosh, watch out, there's a crash.
We're not scared. He's got to smile a lot.
Right.
He's got to smile a lot.
Yeah, exactly. We're not scared. Don't worry.
And the markets will read something into that, I'm sure.
What about a piece of paper? That's the piece of paper too.
That's not funny. These anchors and these analysts, they're financial actors. But you just saw for a brief second that they were admitting that he has to keep the confidence going, right? So they're like, ha ha ha, he's gonna lie. He needs to smile and look confident. So let's continue.
The Federal Reserve leaves interest rates unchanged at 2.25% to 2.5%, no change. But the Fed says it will be, quote, patient in figuring out its next moves when it comes to interest rates, and has altered or revised its balance sheet policy to say that it will make changes if necessary. We'll get to more detail on that in a second. There's a separate statement on the balance sheet on that, but they do say that market-based measures of inflation are lower. So ultimately, this Federal Reserve did not change the outlook on the economy, but made some pretty important changes to its policy statement. Kelly?
Steve, one trader just said Fed throws in the towel. Throws in the towel, capitulates to the market, basically.
Let me just be clear here that in this balance sheet statement that I've read, the Fed did not actually change the runoff. In other words, the process by which it is now reducing the balance sheet from what economy.
Alright, so there was the rate decision, and she's laughing again that the Fed just capitulated, which is absolutely true. And within literally like 10 to 20 minutes, gold, you could see, just took off like a rocket. Pretty much it shot up $8, which is a lot within like 10-15 minutes. Now, of course, there are knee-jerk reactions during FOMC meetings, but this time, that was a good move by gold, the gold market, as a safe haven asset. For you crypto people, I'm sorry to tell you, cryptos don't care. They didn't move not a dollar. Like, they don't even know what's going on in the real world, which is ironic because it's supposed to replace the system. I don't know. All right, so, but Leisman was saying that the Fed runoff, right? That they're not going to change the runoff. Well, if you actually look at the balance sheet, which is not audible, they can't do an audit on the Fed for some reason. Like, it's an entity outside the rules and laws, and that's because the Fed is what enables government to grow as big as it does beyond its means. So that's a whole different story. Anyways, the runoff, it's not significant. The balance sheet is actually growing. Or it's not. They are reducing it, but not by much. Okay, there's still money being injected into the system because the rates are so low. It's not higher than actual rate of inflation.
In the judgments we made about our interest rate policy and our balance sheet, and we'll cover the decisions we made today, as well as our ongoing discussions of matters on which we expect to make decisions in coming meetings. My colleagues and I have one overarching goal: to sustain the economic expansion with a strong job market and stable prices for the benefit of the American people. The U.S. economy is in a good place, and we will continue to use our monetary policy tools to help keep it there. The jobs picture continues to be strong, with the unemployment rate near historic lows and with stronger wage gains. Inflation remains near our 2% goal. We continue to expect that the American economy will grow at a solid pace in 2019, although likely slower than the very strong pace of 2018. We believe that our current policy stance is appropriate at this time. Despite this positive outlook, over the past few months, we have seen some cross-currents and conflicting signals about the outlook. Growth has slowed in some major foreign economies, particularly China and Europe. There there is elevated uncertainty around several unresolved government policy issues, including Brexit, ongoing trade negotiations, and the effects from the partial government shutdown in the United States. Financial conditions tightened considerably late in 2018.
All right, did you hear that he switched the blame for him not raising rates again as he's supposed to? Because a tightening cycle is a cycle. You just keep raising the rates. You don't just take breaks. Because if you take a break, that signals that the economy can't handle it. But what he's saying is it's the global economy, China, Europe, Brexit, and the government shutdown. Now, there can be some truth to that, but listen, that's what they want, because the U.S. is going to be the last domino standing, and I've been saying that for months, for over a year now. So I just wanted to mention that.
And remain less supportive of growth than they were earlier in 2018. And while most of the incoming domestic economic data have been solid, some surveys of business and consumer sentiment have moved lower, giving reason for caution. We always emphasize that our policies are data dependent. In other words, as economic conditions and the outlook evolve, we take that new information into account in setting our policies.
Not true. It's not data dependent. It's based off the stock market, how it's doing. If it's crashing, they're gonna stop raising rates because they're not gonna prick their own bubble, right?
We are now facing a somewhat contradictory picture of generally strong U.S. macroeconomic performance alongside growing evidence of cross currents. At such times, common sense risk management suggests patiently awaiting greater clarity, an approach that has served policymakers well in the past. With that in mind, I'd like to spell out how the Federal Open Market Committee has been thinking about these issues. At our December meeting, we noted the solid outlook for steady growth, vigorous job creation, and price stability. We also stressed that the extent and timing of any rate increases were uncertain, and it would depend on incoming data and the evolving outlook. We therefore said that we would be paying close attention to global economic and financial developments and assessing their implications for the economic outlook. Today, the FOMC decided that the cumulative effects of those developments over the last several months warrant a patient wait-and-see approach regarding future policy changes. In particular, our statement today says, in light of global economic and financial developments and muted inflation pressures, the committee will be patient as it determines what future adjustments to the target range for the federal funds rate may be appropriate. This change was not driven by a major shift in the baseline outlook for the economy. Like many forecasters, we still see sustained expansion of economic activity, strong labor market conditions, and inflation near 2% as the likeliest case. But the cross currents I mentioned suggest the risk of a less favorable outlook. In addition, the case for raising rates has weakened somewhat. The traditional case for rate increases is to protect the economy from risks that arise when rates are too low for too long, particularly the risk of too high inflation. Over the past few months, that risk appears to have diminished. Inflation readings have been muted, and the recent drop in oil prices is likely to push headline inflation lower still in coming months. And stable, financial market measures of inflation compensation have moved lower. Similarly, the risk of financial imbalances appears to have receded, as a number of indicators that showed elevated levels of financial risk appetite last fall have moved closer to historical norms. In this environment, we believe we can best support the economy by being patient in evaluating the outlook before making any future adjustment to policy. Let me now turn to balance sheet normalization. Over its past 3 meetings, the FOMC has held in-depth discussions on the final stages of this process. Today, we made some important progress in clarifying the path forward, as summarized in the statement regarding monetary policy implementation and balance sheet normalization that we released with today's FOMC statement. The committee made the fundamental decision today to continue indefinitely using our current operating procedure for implementing monetary policy. That is, we will continue to use our administered rates to control the policy rate with an ample supply of reserves so that active management of reserves is not required. This is often called a floor system or an abundant reserve system. Under the current set of operating procedures, as outlined in the...
Alright, so this is new. An abundant reserve system, meaning they want the banks and themselves and their balance sheets to stay abundant with extra liquidity and cash. And you could argue that's really in preparation of a downturn. So they could use the extra cash in case their loans start going bad.
Implementation note released today. This means that the federal funds rate, our active policy tool, is held within its target range by appropriately setting the Federal Reserve's administered rates of interest on reserves, as well as the offer rate on the overnight reverse repo facility, without managing the supply of reserves actively. Other questions regarding the remaining stages.
So he's talking about the Fed's balance sheet, which affects the other banks, right? Like JP Morgan, all the other huge monopoly banks that we have now in the US. And he doesn't want to disrupt the free cash flow and liquidity and balance sheets of all these banks. So he's saying that the Fed could keep a larger balance sheet. And the balance sheet is enormous. It's trillions of dollars because they bought up all the mortgages and all the debt in 2008, and they're still holding it, like the Bank of Japan. Like, if you look at Japan, they haven't had economic growth since like 1990, since their bubble popped. And their central bank's balance sheet is enormous. It's like half the nation's entire GDP. Their central bank has bought up the entire stock market, not just their mortgages and bad loans from the banks. So that's what he's talking about. That the Fed it could have its balance sheet larger than usual. It's just you have to sort of see through the way they talk.
The balance sheet normalization. The decision to retain our current operating procedure means that, after allowing for currency in circulation, the ultimate size of our balance sheet will be driven principally by financial institutions' demand for reserves, plus a buffer, so that fluctuations in reserve demand do not require us to make frequent, sizable market interventions. Higher reserve holdings are an important part of the stronger liquidity position that financial institutions must now hold. Moreover, based on surveys and market intelligence, current estimates of reserve demand are considerably higher than estimates of a year or so ago. The implication is that the normalization of the size of the portfolio will be completed sooner and with a larger balance sheet than in previous estimates. In light of these estimates and the substantial progress we've made in reducing reserves, the committee is now evaluating the appropriate timing for the end of balance sheet runoff. This decision will likely be part of a plan for gradually reaching our ultimate balance sheet goals while minimizing risks to achieving our dual mandate objectives and avoiding unnecessary market disruption. We will be finalizing these plans at coming meetings. The process of balance sheet normalization is unprecedented. Throughout this process, we've attempted to lay out our plans well in advance, and we've been willing to make changes as we learn more about the process. The implementation and normalization statement released today is intended to provide some additional clarity regarding the conditions under which we might adjust our plans. The statement makes 3 points. First, as we've long emphasized, the federal funds rate is our active monetary policy tool. Second, as far as the particular details of normalization are concerned, we will not hesitate to make changes in light of economic and financial developments. This does not mean that we would use the balance sheet as an active tool, but occasional changes could be warranted. Third, we repeat a sentence of the normalization principles we adopted in June of 2017. While the federal funds rate would remain our active tool of policy in a wide range of scenarios, we recognize that the economy could again present conditions in which federal funds rate policy is not sufficient. In those cases, the FOMC would be prepared to use its full range of tools, including balance sheet policy.
Did you hear that? That's capitulation. He said, well, if the economy and the stock market start falling, then we'll use interest rates. Unfortunately, it's only at 2.25, so they can't cut it that much. And then they're going to have to do quantitative easing, which is basically the Fed goes in and buys everything up and prints money to do it. And then the Fed's balance sheet grows larger.
Times of economic uncertainty put a premium on the clarity and predictability of FOMC policy. We are committed to clearly explaining what we are doing and why we're doing it, both regarding the path of rates and also regarding management of the balance sheet.
You said recently that the stance of policy was still accommodative and that the economy didn't require that anymore. Is that still the case? If so, how do you justify the removal of the need for some further interest rate increases? Basically, are we at neutral now, or does the economy still need accommodation?
We think that our policy is at the appropriate point right now. We think our policy stance is appropriate right now. We do. We also know that our policy rate is now in the range of the committee's estimates of neutral. So we'll be, we think our policy stance is appropriate.
He said appropriate like 3 times. It's so if this is their neutral range, then this, according to them, is normal interest rates, which is it's not. Like I said, Paul Volcker raised it. I wasn't alive then, but 15 or 20%, and historically it should be around anywhere from 6 to 8%. This is not normal. And he's he's gonna start mumbling. It's funny. That's how you know he's getting nervous.
Heather Long from the Washington Post. Last week, the IMF said risks are clearly skewed to the downside for the U.S. and global economy. Can you clarify, does the FOMC see risks as skewed to the downside, particularly after you removed the statement about risk being balanced?
We had an extensive discussion of the baseline and also of the risks to the baseline. And the risks are, of course, the fact that financial conditions have tightened, that global growth has slowed, as well as some, let's say, government-related risks like Brexit and trade discussions, and also the effects and ultimate disposition of the shutdown. So we look at those. And
Steve Leisman, CNBC. Mr. Chairman, did the committee discuss an actual change to the runoff policy or the runoff schedule right now? If so, if not, is that under consideration right now, and when might we know? The second thing is, I have to nail down this thing. You guys, Fed folks, keep mentioning the market average or the market outlook for the size of the balance sheet. Are you endorsing the market average, which is $3.5 trillion? And if you're not endorsing it, why do you keep mentioning it?
Okay. So today I'm here to talk about decisions and also discussions about decisions that haven't been made. So we're talking about the latter thing, which discussions, and so I can't get ahead of where decisions are. But so the committee what we're looking to do is create a whole plan that will bring us to our goal, our longer run goal, which is a balance sheet no larger than it needs to be for us to efficiently and effectively conduct monetary policy, but to do so in a way that doesn't put our goals at risk or result in unnecessary market turmoil. So there are a lot of pieces to that, and we've learned over time that it's when designing these plans, like for example the original normalization plan, it's good to take your time, let the best ideas rise to the top, let them stand the test of time and argument, and then move when you're really comfortable with what you've got and when you feel you can communicate it clearly. So I don't want to get ahead of that process today. But so we've discussed there are a number of pieces to that puzzle. There are several different pieces to them, and I think they're coming in very pleased at the progress that we've made. And the piece that you mentioned is something that is in those discussions. That's the first question. I'm not going to give our estimate or ratify anybody else's estimate of what the equilibrium balance sheet is here today. There are estimates out there, but I'm not at a point today where I'm going to be giving out numbers on that. But there are estimates, and I think they're consistent with what I said, broadly speaking.
Sounds like a bumbling idiot. Let me translate this Fed speak to you. And Fed speak means they talk in a certain way so no one could decode what they're saying. And basically that is because they don't know what they're doing. But in a way, I do know that they know. They know what I know. And that's why he's nervous, and that's why he's speaking in circles and making no sense. Let's carry on.
You did discuss reducing the pace of the runoff. It sounds like what you said today.
Yeah, it's so, again, we haven't made any decisions. No decisions have been made, but there are different pieces of the thing, and that is in the discussion, as one of many pieces that is in the discussion, and that was reflected in the last minutes, actually.
I'm struggling a little bit to understand what has changed since we sat here with you 6 weeks ago. You've said today that you think that inflation would be the reason that the Fed would need to continue raising rates. Has the inflation outlook shifted that dramatically in the last 6 weeks? Can you speak specifically to why you've moved from a posture of saying we expect to keep raising rates this year to a posture of standing still?
Let me answer that question. It has nothing to do with inflation. It's because the stock market fell 20% in 6 weeks. What has changed in 6 weeks? It's the stock market. That's what's changed. They have to keep it up because if they can't let it fall any further, because the stock market, if it falls any further past that 20%, which it's not there anymore, it did bounce much higher. But if Powell raised rates right now, the stock market would sell off again. And just by looking at the patterns as a trader, the technical patterns on the charts, it would have looked extremely negative. That's why they're not raising rates.
So I point to a couple of things. First, the narrative of slowing global growth continues, if you will. The incoming data have shown more of that. We've seen that both in China and in Western Europe. And so that has important implications for us, and that story has, let's just say it continues. And in addition, I think important, possibly less important now, probably less important now, but has been the shutdown, which will leave some sort of imprint on first quarter GDP. We don't know the ultimate resolution of it. If that's all there is and the shutdown is gone and there isn't another shutdown, then we'll get most of that back in the second period, but the second quarter. So those things. In addition, you have to look back. Financial conditions began to tighten in the fourth quarter, and
radio. You said you like to be a plain speaker, so let me try to have you put this as plainly as possible. Is it fair to characterize this as not a pause in a tightening cycle, but the end of the tightening cycle now, a new regime for the Fed? And if not, can you put a time frame on patient? Does patient have some sort of time frame? And I'm wondering about your reaction to the criticism you got on your December 19th news conference, your later statements. Do you feel you've put a...
Let me answer that real quick. This most likely is the last rate hike. Possibly ever. Or not even rate hike. We already had the last rate hike. Can they raise rates again maybe later this year? It all depends on what the stock market's doing. If the stock market's going sideways, slightly up, they will raise rates again. If stock market makes new all-time highs, they will slip in a rate hike sometime again this year in 2019. But if the stock market does not make a new all-time high, or it trades sideways, slightly down, they're not going to raise rates again. And I don't know what's going to happen after that. Maybe never again.
Powell put into the markets.
So patience, I think we're going to know in hindsight, because the length of this patient period is going to depend entirely on incoming data and its.
He's calling it a patient period, meaning we're just going to stop raising rates for now. Let's be patient. Let's see what the data tells us. And it was funny because that reporter is said the Powell put, which comes from the Alan Greenspan put and the Ben Bernanke put and the Janet Yellen put, meaning that whenever the Fed says, all right, no more rate hikes, or they keep pausing rate hikes, it's very bullish for the market because that means that the free money cash flow can keep going into the stock market and making it go higher.
Implications for the outlook. So that's going to be, so it's hard to say, it's hard to think of what to call it at this point or how to label it. So really your second question is about how do we think about financial conditions? And I would say this, we think about a broad range of financial conditions, not just one or two things. It's interest rates, it's risk spreads, it's currency, it's the stock market, it's credit availability, it's many factors. And what matters for financial conditions is when there are changes, and those changes are sustained for a period of time, then they become important for us because they have important macroeconomic implications. So that's how we think about it. So we don't react to to most things that happen in the financial markets, but when we see a sustained change in financial conditions, then that's something that has to play into our thinking. In fact, our policy works through changing financial conditions. So it's sort of the essence of what we do.
Long-term federal funds rate is 2.8%. I've talked last year with a number of Fed presidents who worry that under 3% is not enough to handle the next recession. You say that's your first tool, so it's your primary means of adjusting monetary policy. So with a larger balance sheet, how could you handle that next recession and with the combination of those two?
I guess the sense.
Now that's a great question. So what he's asking is, if the interest rates don't normalize to 8% and we do have a recession, then what in the world is the Fed going to do? Because their balance sheet is already, what is it, 3.5 trillion, and the interest rates are only 2.25, so lowering the interest rate would not do much from stopping the recession. And their balance sheet's already extremely large, meaning the market could lose confidence in the Fed entirely, because the only thing they're going to be left to do once they've lowered the rates, and it'll drop straight to zero, is print money. And at that point, the Fed has already proven that printing money doesn't really save an economy. It only just blows bubbles in the stock market. The financial markets, they'll become a giant bubble, and it helped the economy a little bit for the last 10 years since 2008, 2009. But this time around, if they print money, we're going to have massive amount of inflation. If you have massive amount of inflation and a recession, which is stagflation, people are not only losing their jobs, but everything is becoming extremely expensive. And that means that people's dollar doesn't, they can't shop, they can't buy things because they can't afford to buy anything because all their money is going to go straight to food. And all the loans they've taken out, they're not going to be able to pay those back. They're not going to be able to pay their mortgage, their car loans, and everything else. So that's the scary issue that they're not directly saying, but this journalist did ask the ultimate question.
Your question is that we could be in a situation in the future. We hope not, but we could be in a situation where we'd like to cut rates more than we can effectively, and we hit the zero lower bound. We don't think anything like that is in the cards now. There's no reason to think that it would be. But
that's his answer. I hope not, because then you would be entirely screwed, and so would the economy and everyone.
As we said in today's release, if that happens, then we'll use the full range of our tools. And That includes the balance sheet. But we would use it after using our conventional tools, which would be the interest rate and forward guidance about the interest rate.
Okay, so he just admitted, he just came clean and admitted that, well, okay, well, first we'll use forward guidance, which is talking about lowering the interest rate. Like, that's supposed to stop the economy and the markets from tanking, which it won't, believe me, when it starts happening. And then he said, then we'll lower the interest rates back to 0. Okay, well, it's only at 2.25, so it's not going to make a big difference. And then they'll go back to the balance sheet, meaning they're going to start printing money. They're going to come in with helicopter money. Like, they're going to come in with helicopters and just drop money. It's like a saying. And then their balance sheet's going to explode. And then, I mean, the Fed is actually bankrupt, right? I talked about that a few videos ago.
Yes, yeah, there would be room to do substantially more.
Yeah, substantially more. Like, more than 2008. Like, double the amount of what they did in 2008. But the question is, will it work the next time to reinflate the economy and the stock market, the entire bubble? That's the elephant in the room. Now, you guys have to understand, they can't just print money. Who's going to monetize? Who's going to buy all that debt? Who's going to buy the U.S. Treasury bonds, all the debt? Because when they print money, they issue bonds and treasuries. Who's going to buy it? Who would be dumb enough to buy it? No one. That's the problem.
About corporate debt. Are you worried that by taking a pause in raising interest rates, we've had low interest rates for so long, are you contributing to a bubble in corporate debt?
So we've
Yes, absolutely. There's a huge corporate debt bubble. And they've been buying their own stocks. So if the stock market tanks, not only does the company lose all of its cash flow, but then the corporate bonds go bust.
We've called out corporate debt as a risk. It's more of a macroeconomic risk, I think, than a financial stability risk. The sense of that being that if you have companies that are highly levered and we do go into a downturn, they're going to be less able to weather that and keep serving their customers, and may have to do layoffs and things like that, so they can amplify and affect a negative downturn. So we watch that. We also watch carefully for the exposure of the financial system to these companies. In other words, banks are arranging a lot of these loans. The question is, what is their exposure? Do they retain big pieces of the loans? Do they have obligations to underwrite loans, which build up in a pipeline? So we monitor those risks very carefully, and frankly, the banks monitor them much better with our support and help than they did before the crisis. So it's a concern. It's something that we're watching. Of course, markets have reacted.
Aren't the banks lending to these? So these corporations could issue bonds. So the banks are lending to the corporations, and the corporations are issuing more debt, bonds, right? It's just like the MBS, mortgage-backed security bubble, except this time it's not just housing; it's everything, including corporate bonds.
Strongly to the decision and the press conference. The Dow Jones Industrial Average is up more like 500 points. There's a sense in the market that there's a new, what people call the Powell put on the markets. Are financial markets wrong in that assessment?
I would point to all the continuity here. The thing we did on the balance sheet is something we've been working on for, frankly, years. The thing we announced today. So we're providing clarity there. I think that's a constructive thing to do. My honestly only motivation is to do the right thing for the economy and for the American people. That's it. And this situation, I think, calls for patience. I think it does. And it's just...
Listen, I'm being kind of hard on Powell. He inherited all of this. Remember that. He inherited this from Bernanke and Janet Yellen. So he didn't... and Alan Greenspan. These are the people who started this bubble money printing Ponzi party. Not Powell. Powell's just inheriting all of this. I don't know why he even took the job. I just want to put that out there.
The stance of policy we think is appropriate. We see these uncertainties, and we see a time when we can afford to. We have the luxury of being able to wait and watch, and that's what we're planning to do. I think it's the right thing. I feel strongly that it is.
As you probably heard, the Congressional Budget Office is projecting that federal debt is expected to surge to about $29 trillion over the next 10 years, reaching the highest share since the end of World War II. First of all, does that sound like it could be a reasonable forecast, with the administration seeming to take plenty of opportunities to question the legitimacy of CBO? And then secondly, what effect does that have on interest rates and the public, if indeed that's even close to being true?
So, first, it is important. We don't do fiscal policy. We don't advise the government or Congress on fiscal policy. So I'll limit myself to more high-level comments and say that.
No, they don't, but the Fed does bankroll it, because the Fed bankrolls the entire stock market, which creates more tax revenue, and then the government could spend more beyond its means. And that's why the national debt, I mean, it's at $22 trillion right now. It's going to be far higher than 29 or 30 within the next 10 years. It'll be there within like probably 3 years, especially if we have another recession, which it won't be a recession. It'll be much worse. And yeah, I mean, the reason there is the Fed is to also bankroll the government, because if we didn't have a central bank, then they couldn't spend beyond their means. They couldn't spend our future away. Then the government would only be able to spend the money that it collects in taxes. Yes, they could still issue treasuries and bonds, but believe me, if there was no central bank printing money, then your foreign lenders wouldn't buy it up.
It is not a secret. It is a long-known fact that the U.S. federal government budget is on an unsustainable path, and that needs to be addressed. And that is driven principally by the combination of healthcare costs, really due to our healthcare delivery system, and the aging of the population. So, and there's no time like now when the economy is healthy, growing, people are working, to go after that problem. Ultimately, we will have to.
He was honest there. I like how he said, and aging population, meaning the baby boomers. I mean, they're the ones who have all the money left, or what's left of their savings. Demographically and everything, it just looks horrible. It looks really bad. And the government, all the entitlement programs are bankrupt, guys. I don't know what to tell you. There's nothing waiting for you there. There's not going to be any free lunch. There's no more entitlement program. He just said, well, the economy's strong now. They should be cutting all of these programs. Yes, technically, but the problem is 30% of Americans get a paycheck from the federal government one way or another, or they work for them. So another issue is our economy's too much reliant on government spending, as it already is. So there's no way around it. There's a reset coming, and it's going to be very, very horrible.
We don't have a forecast. We don't forecast those things. I have no reason to doubt CBO's numbers on this. I haven't actually looked at that report, but my general experience with them is that it's a professional outfit.
So what does that look like?
The work that we do relates more to the medium term rather than the long term. And so I don't see this in particular as a threat to this business cycle or to the economy this year. It's more, in the longer run, we'll be spending all of our money on paying interest and not on the things that we really need to be doing for future generations and for our own generation. So it's a serious problem, but it's not a problem that is something that either helps or prevents the Fed from doing our job today.
Listen, the economy cannot grow its way out of this problem, and the reason is because of the easy interest rates and the money printing. So the Fed definitely has something to do with the fact that the government could spend and promise things that it can't afford. Also, that's what he said about the interest right there on all the debt that the entitlement programs and all the wars we had in the past are racking up. He's meaning that at some point we can't even service the interest on all the debt, and we're heading towards fiscal Armageddon. All right. And that was it. So if you guys enjoyed this video, smash that like, leave your thoughts and opinions, or leave anything in the comment section. It helps my videos. And yeah, the links are below this video. Check us out. There's a free chat groups. Also, if you haven't watched this, you really need to. This video right here, the Ultimate Gold Panel Forecast for 2019. It's really good. I posted it in the newsroom of WolfPack Cryptos and the chat room of MMGinvest. So you guys should watch this. It's really, really good. And relax. The portfolio, the research, it's coming out hopefully by tomorrow. All right. And I know that gold's taking off, and more than likely we might get one more dip and a retest of 1300 support, but after that it's metals are going into a multi-year bull market, and you do not want to miss that. And the wait for the MMG research, it's well worth it. All right, guys, this is, I don't think anyone out there has made a report like this, and I've purchased and I've seen a lot of reports personally. So the wait will be worth it, and just be patient. As Powell says, be patient. I'm gonna try to release it tomorrow. Okay, if not, I can't make any more promises. It's just that there's a lot that goes into it, a lot of work. All right, looking at balance sheets, revenue, there's just a lot that goes into the research, and I want to release the best work humanly possible so we could all benefit as much as humanly possible in the coming years. All right, guys? Until next time.